Is the stock market about to crash? Should I wait to start investing? Is it too risky to get started? These are questions that we're getting from the Equity Mates community, and in today's episode, we're going to answer all of them. If you're wondering how to invest when the markets are hitting all-time highs, this is the episode for you. Welcome to Get Started Investing, a show that helps you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. How could I not be? We are answering the question that is at the top of everyone's mind at the moment: what to do when the market's hitting all-time highs.
Yeah.
Before we even get into the episode, let's start by acknowledging that this is a completely normal concern. Like, everyone from beginners to experts who are investors are trying to answer the same question at the moment. Like, is this a bubble? How much of this AI story is real? How much of it will deflate on the first sign that OpenAI and Sam Altman can't live up to the promises they're making? And like, the fact of the matter is we don't know. And so we're going to try and answer it with what we know and then talk about, whether or not it is a bubble. How should you invest in an environment like this?
So these are all questions that are coming through from the Equity Mates community, and we have two here today, one from Chris and one from Joel.
Hey guys, I am quite a sporadic investor, only a few $100s occasionally. I'm just wondering, what is your opinion? I know you've previously mentioned the AI bubble popping possibly within a few months or a few years. Is it worth holding off and stockpiling a little bit of extra cash and waiting for this bubble to burst, or should I continue to invest like normal?
G'day Equity Brothers. I'm looking for some advice on how to reassure my risk-adverse partner whose family has had bad experiences with the stock market in the past, that investing over the long term, say 20 years in broad diversified ETFs, is actually a smart and safe way to build wealth. How can I help them understand that with the right strategy, our investments can be protected from major market crashes like the GFC, and that staying invested for the long run is less risky than not investing at all? Love the work you do, gentlemen. Keep it up.
Love it. Thank you so much for the questions from Chris and Joel. I want to start with Joel's first. We should actually put this in our show notes. There's a chart that shows the probability of loss over a 20-year period, both in Australia and the US. When you hit that 20-year period mark, the probability of losing money, if you stay invested over that 20-year period, is zero.
Yeah.
Has been zero, not to say it'll stay.
That's based on the historic returns of the market. Is any 20-year period, if you just held through it, even you didn't lose money.
Yeah.
I mean, that kind of does answer Joel's question, but we've got some more information to answer Joel's question. If we can just go to Chris's question for a second. I don't think we've never said it's an AI bubble, and we certainly said an AI bubble that's going to pop.
I reckon he's referring, if he's an Equity Mates investing listener, we did that chart where we showed that we're sort of 3 months from peak based on JP Morgan.
Yeah, but that was a premise to say we don't think it's a bubble.
Yeah.
Chris, you got to listen to the whole episode.
Stop listening then.
But look, let's get into it. Let's in this episode, let's start with that question: are we in a stock market bubble? Then talk about how to invest generally when markets are hitting all-time highs. And then let's close by talking about how we're personally approaching a moment like this. Are we doing anything differently? But let's start with the big question that's on everyone's lips. Are we in a stock market bubble?
Whoa, what is a bubble?
Great question.
So a bubble is where the price of an asset and its underlying fundamentals just get way out of whack.
Yes.
And there's a huge run up in price that doesn't match the underlying value of the asset. Its profit profile, its growth profile, its underlying value.
Yeah.
It becomes driven by speculation, fear of missing out. We've all seen the photos of people at the ABC Bullion store in Martin Place.
I don't know if we've all seen those.
A lot
photos.
of people may have seen them.
For people who
lines.
haven't seen them, there's a store in Sydney city where you can buy gold, and the lines outside of it, people are queuing up like it's Taylor Swift tickets.
Literally, yes. And some classic examples that we often refer to in history. You've got the late 90s tech bubble where the prices ran up, but the businesses that were underlying them were just some didn't even really exist.
Yeah. It was all based on like the
hope
of the future rather than like the reality of the money the businesses were making.
Exactly.
I think a more recent example that really illustrates bubble behavior is the NFT boom of 2021.
Yeah.
because all of a sudden these digital JPEGs that were minted on the blockchain but didn't have any like intrinsic economic value were selling for literally millions of dollars.
Yeah.
Like Bored Ape.
A PDF.
No, JPEG.
JPEG, yeah.
You could change the file format. Bored Ape Yacht Club was, being bought by celebrities for tens of millions of dollars. It was a bubble. There was no reality underlying the value of these things. It was purely emotion and speculation. And so that's what we talk about when we say there's a stock market bubble. The reason a stock market bubble is bad is because of what follows the bubble, which is when it pops.
Yeah, a spectacular crash
And
often.
you can probably buy a Bored Ape Yacht Club NFT for maybe
$bucks.
No, probably thousands.
So that brings us to why are questions being asked today about, are we in a bubble? And rightly so. We've had some pretty significant run in prices.
Yep.
We've had the S&P 500. It's up 110% in the last 5 years. And it's been driven by some of the large tech companies.
Yeah. Just hold on that for a second. So the S&P 500 is the 500 largest companies in America. It's one of the most vanilla investment options you can do. If you had bought that 5 years ago, an index ETF, you would have more than doubled your money.
Yeah.
By doing nothing.
Yeah.
In 5 years.
Yeah, Joel, put that in front of your family.
So I think it's just worth reflecting on investing. Doesn't need to be
You
complicated.
didn't need to pick a stock.
It doesn't need to be like an incredibly time-consuming thing.
Yeah.
If you just invested in a vanilla investment product that owned a bit of everything over the past 5 years, you would have been up more than double.
It's crazy. So with that in mind, though, if you look at most sort of I would say the last 18 months or so, a lot of the gains have been driven by the AI trade. A lot of the companies that are in the AI space are driving a lot of the S&P 500, and that's why people are starting to think, well, hang on, it's not the top 500 companies now, it's probably just the top 5 that are really pushing up prices here. So fair enough, people are asking, hey, are we in a bubble? But there are some arguments to say that we're not in a bubble. One of those is that markets hitting all-time highs is normal over time. This isn't the first time that it's happened. Economies grow, companies innovate, markets, evolve. And so to have asset prices and markets hitting all-time highs is a natural part of the cycle.
Yeah.
It's not unusual.
Yeah, and then the question is the AI story of today similar to the internet story? That's kind of the analogy that people are making. The fundamental difference is the biggest winners in the AI story are backing up the numbers, at least for now, with real dollars and real growth. They're these big, tech companies, the Magnificent Seven, led by NVIDIA. The other thing which I found really interesting, there's a couple of minutes video that is probably too long to play here, but I'll summarize it, was Andreessen Horowitz, the VC investor, made the point that the big infrastructure build during the internet era was laying fiber optic cable. 97% of the fiber optic cable that was laid was dark. It wasn't used. It was all anticipated for future demand. The internet was going to change the world and we're going to build the infrastructure today because it will be used one day. They actually weren't wrong. They were just like they were like sort of 15 years early.
Yeah.
Whereas there's no dark GPUs today. Like every chip
All
that
being used.
NVIDIA makes is being used.
Yeah.
And so it's not a perfect analogy. I recognize there's some shortcomings, but the difference between the internet boom of 2000 or the late 90s and the AI boom of today is that the AI boom is like not based on the hope of the future, but it's like being used today. There's real money being generated today, and that might change in time. Valuations could keep running, infrastructure will keep getting built, but I think there is a fundamental difference.
Absolutely. So with that in mind, let's try and answer part of Chris's question, which is, should I be holding off and stockpiling cash? Should I be waiting for it to burst, or should I just be getting in and getting it done? Because at the end of the day, Ren, we could be right, we could be wrong, we don't know.
Yeah, exactly.
So how do we approach this? Because sitting on your hands is definitely, in my opinion, not the way to do this.
Yeah, there's a lot of cognitive biases when it comes to investing. We have to beat our brains, and one of them is the risks that we can see, we become very focused on. And the risk in this case is the question, is it a stock market bubble? We're not as good at weighing that with risks that are harder to see. A classic example of that is we always underestimate the impact of inflation over time because it's hard to see that.
Yeah.
Another risk that's really hard to see is the risk of not getting started investing.
Yeah.
the risk of what it will do to your future financial choices, the flexibility you have in life. In my opinion, and the numbers back this up, the bigger risk is not getting started.
Yeah.
Waiting for the market to fall, waiting for the perfect time to buy. It could leave you years in the dust. You know, the last 5 years, we said earlier, the American market has doubled. You could watch the American market double again as you're waiting for the perfect time to get started.
Yeah.
And the challenge is, even if you find the perfect time to get started, you often don't realize it was the perfect time until after the fact.
Yeah.
Because trying to time the market is a two-step process. It's being right about when the market is going to fall, but then also being right about when the market is going to start rising again.
Yeah.
And if you look back in history, those points are often the scariest points. It's 2008 when people were panicking about a double dip recession and Europe having a bankruptcy crisis. It was the COVID pandemic in March 2020 when cities were being shut down and the virus was spreading massively and international trade was being slowed. Those were the moments when it was time to get back in.
Yeah.
I would hazard a guess that most people don't time the market right on the re-entry as well.
Yeah.
So you can sit on your hands and wait and wait and wait and then still miss your opportunity.
Absolutely.
Yeah.
Absolutely. So while logically trying to pick the bottom is what everyone thinks about doing, even investing at all-time highs is better than not getting started, as you said. And we have an example that we always turn to.
It's well-trodden.
It's well-trodden. If anyone has another example that they'd like us to use. But this one just proves the point so clearly. It relates back to the GFC, which is where one of the largest banks, the Lehman Brothers, collapsed. And they collapsed on a Monday. If you'd invested in the S&P 500 on the Friday before the crash, in the first 6 months, you would have been down 50%.
Ouch.
Ouch. Not ideal. However, 10 years later, if you'd held through that period, you would have doubled your money.
Not bad.
Not bad. If you'd reinvested your dividends, then you would have almost tripled your money.
Even better.
Even better. So I think it just illustrates that buying at the highest point and holding through, markets always recover or have recovered over a long period of time, and trying to pick bottom or being scared about investing at the top really does impact your long-term returns.
Yeah. Now, I think that goes a long way to answering Joel's question, but to close out the answer to Joel's question, which was around how do I convince my risk-averse family that we're not going to lose our money, I want to reintroduce one of my favorite sayings, a saying that we have coined, hasn't really caught on yet, but I think it will one day, which is companies die, indexes are forever. And our perception of risk when it comes to the stock market, well, take a step back. The risk that we're trying to avoid is losing our money.
Yeah.
We know that over time markets will go up and down. That's called volatility, and that's okay because over the long term market trend upwards. But what you don't want to do is permanently lose your money. And the way that you can permanently lose your money as a stock market investor is investing in a company that then goes bankrupt, goes to zero. And there have been examples of that. And if we talk about the dot-com bubble, the late 90s tech bubble, there were plenty of examples of that. Webvan that tried to do grocery deliveries, Pets.com that tried to do e-commerce pet supplies. I mean, the real takeaway with some of these companies is that they were right. They were just way too early.
Yes,
but,
yes.
Those companies went to zero. People that invested in those companies lost their money on those companies. You can't avoid that fact. But that's when you invest in individual companies. It's different when you invest in an index, which is the collection of companies, the S&P 500, the 500 biggest American companies, or the ASX 200, the 200 biggest Australian companies. The way indexes work, as companies move up and down, the indexes get rebalanced every quarter. And so, Pets.com never made it into the index, but if it did and it went bankrupt, it would get dropped out. And then the 501st company in America would get moved in. And so that way indexes are these evergreen tool that change as economies and markets change, and they don't go to zero. The only index that has gone to zero is the Russian stock market index in 1917. Quick history lesson for you. What happened then?
It went to zero.
No, but why?
I don't know.
Russian Revolution. Communists took over, shut the stock market, closed all stocks. There was no private property anymore. In that moment, the Russian stock market index went to zero. If that moment doesn't happen, the index will keep churning along, fueled by new companies, new innovation, new entrepreneurs listing their businesses. And so indexes can fall, but the reason we say they're forever is because they don't go to zero in that way. They are just always a reflection of the 200, 500, 10,000, whatever, biggest companies that make up that index. And so that's why the index recovers after these crashes and recovers and then keeps growing.
Well, we're going to take a quick break, and on the other side, we're going to go through how we invest using indexes and set up our portfolio to invest at a time like this. So we'll be right back. Welcome back to Get Started Investing. We've had a couple of questions come through from Joel and Chris around how to approach investing if it feels like we're in a bubble. We've covered off a lot of the theory, Ren. Let's put it into practice and talk about how we invest at a time like this, because as we've noted, not investing is the worst thing that you can do, but there are ways that you can set up an investment strategy that takes away a lot of the worry, I would say. So, Ren, we've got 5 steps to think about when it comes to investing in a time like this.
Yeah, and you might find, interestingly, that what we talk about here, they seem very similar to investing at any time in our mind.
Yes.
The first one, have a cash buffer or an emergency fund. Now, this is just an important general rule, but specifically if you're worried that markets are hitting all-time highs, you want to make sure you're only investing money that you don't need in the short term. Because the reality is the market at any point could fall 10, 20, 30, 40%.
Yeah.
And so putting money away that you want to put down on a house deposit or spend on a holiday next year, you might find that instead of going to Barbados, you're going to Burke if you put your money in the stock market and it falls.
Yes.
So have a cash buffer, have an emergency fund, anything you're saving for in the short term, put it in a high interest savings account and invest money that you can put away for the long term.
Yes. Secondly is just get going. Don't sit on your hands. I think we've spoken about the impact of not getting started. So just get started, start small, start with what you're comfortable with, start with money that you can afford to lose. I can guarantee that you'll find out that it's not as scary as you think.
Yeah.
If you want to go through the full 12 steps that we did at the very start of our journey, head back to the #1 episode and Get Started Investing, where we set it all out for you nice and clearly.
So the third point is dollar cost average. And if you're worried about the market being at all-time highs and you think it might crash, dollar cost averaging is a strategy that allows you to invest when the market's high and then invest when the market's low, because the strategy says invest the same amount regularly.
Yeah.
The best way to do this is align it with your pay. So if you get paid fortnightly, every fortnight you're taking some percentage of money from your pay that you can afford to invest and you're putting it in every fortnight, regardless of what the market is doing, for years and for decades to come. Sometimes it'll be up, sometimes it'll be down. There's always a reason to worry. There's always a reason for financial media to get people to panic, click on articles and get that ad revenue. But the important thing is you're just consistently investing all through that time. And
then automate that process as much as you can. Take the emotion out of it. The more you can keep the process going but not have to think about making any decision, the more powerful it will become. Get a broker that can automate buying the ETFs. Find a bank that can automate the transfers to your broker. You don't have to think about it. You don't have to worry about where the market's at. Just set it up and forget.
Yeah. And then the final point is diversify. So if you're worried about this AI story, simply don't put all your eggs in the AI basket. And particularly, a lot of this AI story is concentrated in America. The great news is wherever you are watching this, wherever you're listening to this, your home country stock market allows you to be globally diversified through ETFs. And so speaking for us here in Australia, we can invest in an ETF that tracks America, one that tracks Australia, one that tracks Europe, one that tracks Asia. We can get globally diversified from the comfort of our own home. And so if you're worried about the AI story, make sure you've got some European exposure, some Asian exposure, some Australian exposure, because we're far less exposed to this AI story than the American exposure. I would say have some American exposure.
Oh, definitely.
Because we don't know where this AI story is going to go. You'd be kicking yourself if NVIDIA GPUs lead to the first super intelligence and you decided to just pump it all into Australian banks and miners.
You definitely want US. You definitely want US.
But that's the beauty of being diversified. You don't have to pick a side. You don't have to say this is a bubble or this isn't a bubble. You can play both sides. And as an investor, have your money grow in either scenario.
And so to close out, Ren, the dirty little secret is that in a time like this, we haven't changed investing at all. We keep dollar cost averaging into our core portfolio exactly as you had it set up there. We look for opportunities as they arise, and the game goes on.
The game goes on. That's a good place to leave it. Keep investing, keep learning, keep joining us on the journey. The best way to do that is to subscribe wherever you're watching or listening. If you want to keep your finger on the AI pulse and keep up to date with the news, we have a daily email that hits your inbox 6 a.m. every weekday morning. You can sign up at equitymates.com/email. But look, whatever happens in markets, we'll be here. We'll be sharing our journey, and we hope you join us, because even if you are feeling a little bit nervous at a time like this, you should be really excited about the opportunity to invest, the opportunity to make your money work as hard as you do.
Keep the questions coming, but we'll leave it there. We'll pick it up next week.